It is December 17th, and of course, this is the video log that takes 30,000 to a million. After I take you through the account, I'm going to talk about Warren Buffett's favorite market measurement and also why it's important to keep the long-term picture in perspective. So, here we go. I'm going into the account and I'm sitting at an all-time high today. So I'm super psyched, very excited, but also a little bit scared. And so I'm taking some precautions. You'll see why in a little bit. But first, let me take you through all of my positions. On the right over here, you're going to see my options. There's a symbol, the ticker, the strike price, whether it's a put or a call, the expiration date, how many contracts, and whether it's a sell or buy. The number on the right just designates the change of liability for the day. So I'm going to quickly run through them. You can pause your video at any moment and you can explore the positions further. You're going to find all relevant information right here. These are my equity positions. Big one is, of course, Apple. I'll show you the account tab and you'll see how big of a share of my account that is. And then I'm trying to accumulate realty income, stock symbol O. And unfortunately, most of my positions, including this one, which it seems like I've gained $1,350 in valuation, but in reality, I've gained about zero. Because I had already sold calls against this position, so I'm just waiting for them to roll off. So that's unfortunate, but such is the game. I wanted to buy some protection. I wanted to sell some calls against it for protection from downside movements, which I think will come eventually, but who knows when. Energy fuels especially might not touch any lower position for years. So I have chemical going down only $100, which is not a lot considering the rise it had recently. And then everything else looks fairly normal. Let's click on chemical to explore it a little bit further here. This is the 1 week chart. It had a very massive explosive move. This is a uranium company, the largest in the world, at least traded publicly in the Western world. The title for the largest one I think still goes to Kazatomprom from Kazakhstan. So chemical had a pretty meteoric rise from 10 all the way up to $14, and now looks like it's having a minor correction. If it heads back down to 11, I will probably start selling puts to try to get back into the position, but I may not get that chance. Chemical may have run away from me without me participating in this. But I'm not too sad, and the reason is because I've been getting money from this fairly sideways movement over the last 5 years. I've been selling puts and calls all along this line, and I've collected a ton of premium. So I can't really be that unhappy about missing out on this ride. I'm going to go to the account tab real quick to show you some of the weightings. I have this chart sorted by total return. You can see Apple valuation changed $20,000 since I bought it. At least since my average, compared to my average entry price. And then it would be energy fuels, but as you know, I'm not getting any of these gains, so that's unfortunate. Same with chemical. But you can see how these uranium companies have climbed up to my top 3, noting the spectacular rise of recent. Then I have the Russian market, which I still have a little bit of room to go. Actually, no, it's sitting at 25, which means I'll be getting out of Russian market soon, be selling that off. And the emerging market dividend fund DEM, I will be selling some of that off as well if the price stays this high. Wheat and precious metals, which I will be keeping. Hercules Capital, I'm getting rid of it if it reaches 15. Now it's at 14.30. I don't mind having it. It's a great dividend and I'm sitting on some gains. Visa, I don't plan on selling. Realty income, I plan on accumulating. Schlumberger, if it reaches 25, I'm out. And then all the other ones are fairly irrelevant because of the position size. So here is sorted by equity. You can see the 3 largest positions I have is Apple, over $48,000. Then PCY, which is emerging market bonds, and then realty income sitting at almost $10,000. Energy fuels coming in close, but as I discussed, that's going to be going away. So these gains are very sad to look at it, but it's a safety thing. It's precautionary, and it's fitting that I talk about precaution because I'm going to sound a little bit bearish on my topic today. I do want to take you, before I do that, I want to show you the gains that I've had today and over the week and over the month. So here's the daily performance chart. I'm up about 1% or almost $1,400 just today. The week chart is 3.3 or $4,600, and then the monthly chart is almost $12,000, sitting at 9% gain. It's the 3-month chart, 1 year chart, 58% on the year, and the old chart. This looks fairly aggressive, but the reason why this is flatline is because I didn't really start investing into this account until I just had a few $100 sitting in it until August 28th, 2018, which is when I started this video series. And now this is probably the 300th episode, so maybe I should do something special. Well, I guess this is special. I'm reviewing the account and I'm talking about how far it's gone. I'm really looking forward to doing my year-end review, which is going to be probably happen around January 1st, and I'll be going to break down how much money I've made. I'm going to break it down per month and how much I've gotten from premium and dividends and everything else. So if you're interested in that, just wait till January 1st or 2nd at the most, and I'm going to break everything down for you so you can see if you're interested. Well, I accidentally hovered over the lowest point ever, which I was down $14,000. What happened there in March is I tried to catch the knife too early and I got cut real hard and I bled, but I went more and more aggressive, and that's why this is so drastic, and that's why it rebounded so sharply as well. I went very aggressive, and that's the reason why I'm sitting at such a high number. Now, I haven't added any money to the account over the last 3 months or anything like that, so these are all natural gains. So that's interesting. Overall, the account, since I've started, I'm up 113%, which is great. Over a couple years, doing really well so far. I'm very happy about it. Now, speaking of performing well and this account sitting at very high valuations, I want to talk about Warren Buffett's favorite market indicator, how he knows or how he likes to look up whether or not a market is overpriced or not. So it's the GDP to market cap. Market cap means market capitalization. Basically what that means is all the stocks value in the US markets put together, and there comes a number of that, right? So how much money people invest. Although I do think that it's not as relevant as it once was, this indicator, because I think that there has been acceleration in the democratization of financial instruments throughout the population, especially of the US, but abroad as well. Stocks and investments are much more popular now, and it seems like it's going to be part of the everyday life of a lot of people, including us, right? I mean, that's what we're doing here. We're becoming our own financial advisors. We're running our own portfolios and accounts, and we're trying to understand how money moves and how to generate wealth so we can have a better future. So this option wasn't really that available to the everyday person like myself or perhaps you, because the instruments you used were very complicated and very complex and out of reach. You need connections, and quite frankly, people didn't even hear about investing and doesn't even know what a stock is or anything like that. It's not common knowledge. It's not something that people talked about. And a good portion of the world at one point, in the not so distant past, used to have a regime that didn't even have a stock market, didn't have companies, corporations, businesses, none of that. Right? Half the world, I say half the world, but not really half the world, but a really large portion almost, was behind the Iron Curtain, which means that there were no such things as, auction houses and businessmen and markets and all that stuff. So half the world missed out on this opportunity and was never educated about stuff like that, and is just now kind of dipping its toes in it. Talking about countries like ex-communist countries like China and Russia, they're used to be very, very powerful and huge influence in the world, and they're probably going to be regaining that status soon, but not through the communistic, economy type of way, but they're capitalizing themselves, and they're starting to share some of their resources with the world and generating wealth. They're taking a page out of the Western nations playbook. Unfortunately, the Western nation playbook the Western nations are taking a page out of the Eastern nations ex-history playbook, which is another topic that I'm not going to get into. So they're trying to make, they're definitely becoming more and more wealthy, these Eastern countries. So here's what I want to show you, right? This is the indicator here, and what I'm going to do is remove my face cam here so you can see the whole thing. And what you're looking at is this US GDP is in the orange line, and then the US market capitalization is in black. You can see that the US market cap roughly follows the movements of the market, and as well it should. This is not an average price of the top 500 companies or anything like that. I think it's total market capitalization. So how much is every company combined valued at? And on the left, I'm guessing that's trillions. So probably around 37 or 8 trillion dollars at this point, perhaps more, is the total valuation of all the companies, at least US registered, versus the United States gross domestic product. That's what GDP stands for. You can see the disconnect. You also note that during the 70s and 80s, the US market cap was not way under, but it was considerably under US GDP. In the 90s, especially in the 2000, year 99, 2000, the market became very overvalued relative to GDP. And then there was a dip, of course, during the crash 2001, 2. Then again in 2007, you can see the market was arguably overvalued in the 2008 dip, and now we're sky high. Global risk has been definitely reduced to an extent. We have much more secure infrastructure. We have confidence in central banks and worldly affairs. We have, like I mentioned, the democratization of financial instruments, more access to the everyday person to invest. And I think that people in the United States I did not mean to do that. I think people in the US are fairly, not lucky, but the people that were born here or they moved here either made a good decision or were lucky, because I discussed in another episode how other countries are it's not in their culture to get involved in this type of stuff. I've mentioned how many people in Australia don't even own any kind of brokerage accounts or nothing. They just have their little retirement account, which is invested by the government. Basically by force, they're required to get into this kind of Australian fund. But other countries like Brazil, only 1% of the population has a brokerage account, whereas over 60% of the US have one. So you can see the disparity. I mean, chances are that none of you guys that are listening to this, including myself, would ever be into stocks, would ever have any kind of chance to, accumulate wealth and take advantage of reinvestments and accumulate, capital, compounding capital through this market system. Our savings would just be either in currencies that would depreciate at great rates faster than we can save them, or they would be forced to save in something like gold, or speculating cryptocurrency or something. I guess that's somewhat popular, but my point is that the options would not be available, not just because um, they're not accessible, but mainly because the general population doesn't understand, or it's not in their culture to do it. It's not a capitalistic type of culture where, people are, obsessed with building capital and reinvesting it and gaining more and more wealth. The path, I mean, I've been in the country like that doesn't invest, right? I came from a country named Bulgaria, and in that country, at least when I was there, things are changing now in the last 15, 20 years, but I left there 23 years ago, and then nobody owned any kind of stock. I mean, they did have this kind of like post-communistic dispersion of capital where everybody could buy stocks and things like that, but many people just kind of sold them out and just bought a little business, or a little apartment or whatever, and then it was just back to day-to-day stuff. Everybody was just trying to make a living for that 1 month so they can pay their bills, and then they had to work and make a living for the next month and so forth. Maybe some of them saved enough fast enough to invest in some housing or real estate or improve their house or whatever, but for the most part, everyone kind of lives day to day. I mean, any kind of big paycheck was spent, whether you buy a car or a house, or not many grew their business or understood how to incorporate or make a bigger deal of what they're doing. So I know that wasn't in the culture. Like, I came from that life. But anyway, I digress. When it comes to the account and investing, I just think that it's time after this huge rise to take a little bit of dry powder on the side to be able to go back in and go back in aggressively and try to catch another knife. So I started doing this back in January, February of the beginning of the year, and it was really, really good timing because then the virus crisis hit, and I went in very aggressively. And towards the end, I really got burnt because the market dropped further than I anticipated. So I lost a lot of valuation, but I recovered, and that cut nearly killed me, right? If the market went down another 10%, then account could have been wiped out theoretically. I probably would have saved it, but the recovery wouldn't have been as swift because I would have done a lot of cutting, a lot of damage to my positions. So anyway, so that's why I'm being a little bit conservative now, and even though I'm sitting at all-time high, I'm letting some things run. I still have Apple call options, which will go down significantly if there's a major correction. But I am starting to accumulate some cash, and I'm really not going into margin. I mean, if I go to the account here, you'll see that I have $8,203 in cash, right? And I'm not in margin, so I mean, theoretically, I could borrow a lot of money against my stocks if I wanted to be aggressive, and that's how I use this kind of leverage strategy whenever things go down. But I can't be putting things in margin at this valuation. I mean, that's very risky and very crazy to me. By the way, as always, none of this is financial advice. I'm just sharing what I'm doing with you and what my ideas are, and I hope that you guys are doing what you know best and you found your own edge to maneuver through the markets. Don't copy me or don't place any of the trades that I do, because chances are you won't manage them the same way that I do. And just because I've experienced some success here doesn't mean that you will be able to replicate it or that it's best to. So I think it's much more profitable for each one of you to go through your own journey and be able to figure out your own way of beating the market that fits your personality, fits your investment style, and build confidence in that and expand on your process. So I did that. I've been investing for over 15 years now, and definitely made a lot of mistakes, and I've been burnt plenty of times, but I'm still growing, and I still got a lot of growing to do. I'm not saying that I'm this perfectly polished investor that's only going to be gaining money from now on, but I definitely know a couple of things to look for, and I've learned from major mistakes before. So I advise you all to, start early, start investing, put some money, have some skin in the game, right? And but not too much. If you're not sure what to do, and if you're still in your exploration process, I recommend that you just stick with either a professional financial advisor, or just put your money into like some S&P 500 Roth account, ROTH, with some mix of bonds and gold or whatever, and just sit on it and keep accumulating capital in there until you learn enough to where you can try to manage a small portion of your own wealth after you've educated yourself, and then you can try to experiment and see what happens. Okay, I think I've talked a lot. This is the 300th episode, and I know I should be a little bit more excited. It's an all-time high, 300. It's a good number, but I just feel kind of scared and cautious at this point. Usually when I feel like this, that means that there's probably a correction, or at least a downturn between now and the next 6 months. But I'm not gonna count on it completely, so that's why I'm not fully in cash, which I'll never be. One of my rules is that I'm always 55% long. I figure out how to, what my beta is, what my correlation to the market is, to get to that number, but everybody has their own process. But anyway, I don't want to be net short in the market, because I'm very afraid of many not headwinds, but tailwinds for the market pricing that I have discussed in other videos, and maybe I will discuss in the future. So for now, I hope y'all are making more money than I am, and if not, stay strong and keep improving your process, and hopefully you keep educating yourself and do better in the future. So let me know how scared you are right now. Like, on a scale of 1 to 10, how scared are you from a drop? I want to throw my hat in the ring and say, right now, I'm like at a 7, okay? 10 being like, I think there's going to be a 1929 style drop pretty soon. Like, that would be, alarming to the 10th. I'm about a 7. I think that there's a lot of optimism here when it comes to stock valuations, and I think it will keep running up for the next few months, but I just don't know for sure, and I just want to be prepared in case things don't go in a positive direction. But yeah, I don't want to go net short, because I'm more afraid of missing out on the run up than taking a big correction, if that makes any sense. All right, let me know how scared you are from 1 to 10. Okay, peace out.